Okay, the big question of the day is, do we do dollar cost averaging or lump sum investing? What is the difference between these and which one should you be doing, right? Okay, to break it down really simply, I want to show you a chart. And I always go back to technicals and charts whenever I am making a decision, pretty much. A lot of people use fundamentals, and that's okay. But generally, I would say really look at charts, get a feel for them, and really start to understand the power in using charts for yourself, especially around making decisions. I always say go back to what you can see, on paper rather than like getting in your mind about something. So basically, the difference between dollar cost averaging and lump sum investing, what those things mean is we already talked about dollar cost averaging, and that's basically where you're able to take your investment money, whatever you have to put into your funds, and you spread it out over a period of time. So you can set up your investments, which I highly suggest that you do this anyway. Go ahead and set them up so that you have monthly withdrawals from your bank account that go right in to the fund of your choice. It just makes life easier. That's what this course is all about. And who has time, right, for looking at like charts and all of that every single day? I was a business owner and it blew me out trying to get up early, figure that out, trade in, trade out. It was too much. It was stressing me out. So, dollar cost averaging basically means that you're getting in once a month, let's say, and you're getting in at different times, different price points along, say 6 months, a year, 30 years, however long you're going to invest for. Okay. So that means that you're going to hit different price levels along the way when you buy in. Okay. So you may not always be getting the best price when you buy in, which we want to buy low generally when we're getting into the market. But over time, the benefit to dollar cost averaging is that you are consistently investing and you get an average over time. All right. So you may not do really, really well, but you're probably going to do pretty well. The benefit to dollar cost averaging and to investing long term and consistently is that you are investing consistently, because what happens to a lot of people is they say they're going to invest, they get the idea one day, they go do it, they put a drop in of $1,000, and then they leave it and forget about it, for years over time. And we just don't want that. We want you to be investing consistently so that you get the power of compounding working to your benefit, right? So what I want to show you is a chart. This is the S&P 500 index. I've selected a year for the time frame, and I want to show you what happens, let's say you invest around, I don't know, the 5th of every month, okay? So you can see here that it closed at 46.97 on the 5th of January. If we scroll to the 5th of February, it was at 49.42. Now, if we scroll to March 5th, we can get there, 50.78. Now, do you see the price is continually popping up over time? Now, you can see this full chart, so you can see what happens over the year. Over the year, this year, we've made 49%, right? That's really crazy for a year in the S&P 500. But what I want you to see, is that sometimes the market took a dip, right? So somewhere in here, the market was down a little bit and then it came back up. And then it was down a little bit in here. This was right around the 5th, August 5th. You actually would have bought at a low, which was good for you, without even trying. Okay, so this is the thing, this is the key. Even though you're buying at highs, some of the time, while the market's still going up, some of the time you're going to be buying low too, without even trying. Okay, so that does happen. Now, what's the difference between that dollar cost averaging, getting the average of all of these prices over time, right? And lump sum investing. Lump sum investing is usually for people who trade. And it also can work well, though, let's say if you're new and you do have money to put in the market and you do see a buying opportunity on the chart. Okay, so if you were to say, look at this chart over 6 months and you see it is going up and you know the S&P 500 is a fairly good buy, it's probably going to continue to keep going up as we've seen, in past charts. And let's say that you do come to this date, August 5th, and you are contemplating putting in, let's say you have $30,000 to invest. Let's say, you received an inheritance or something or a bonus from work, and you're like, hey, I want to put money in the S&P 500 into a fund, and I have 30 grand to do that with. You can take a look at the charts and help make that decision for you as to what day you want to go ahead and try to enter. Okay. Generally, I would say to look for a little bit of the market starting to return because we don't know if the market, say on August 5th, it was starting to go down. We don't know if it's going to continue going down and give you an even better buy-in price point. So at that point, you may want to wait a couple days, but be looking at the chart each day. Get a sense of, okay, look, it's starting to turn here now, right? I feel a little more confident there. So that may be a key place for you to go ahead and put your $30,000 lump sum, means you're taking the whole lump of money and investing it in to that fund all at once. Okay, so that's the key difference. Now, what I want to say here is for a lot of people who are uncomfortable with putting in a lump sum, what can help is to break that up over time. And so you may want to take, say, that 30,000 and decide for yourself how much feels okay to put into the market today. For myself, maybe it's 10,000 of it because you're not sure about this whole investing thing yet. So maybe you keep 20,000 in the cash fund and the settlement fund. You can still send your money over to your account and have it waiting for you. So you can put it in to your settlement fund. And let's say take 10,000 and go ahead and send it as a buy order to buy your fund. Okay. And then maybe a month down the road, once you've been watching the market, let's say you see, oh, it's gone way up, after this August 5th buy-in, it's gone way up. It's doing really well. And then let's say on the 5th, here it is, kind of somewhere in here. Okay. It's looking okay. It's looking pretty good. You're looking at the past chart. It's been going up this whole time. Let's say now you're ready for that next 10,000 to put it in. Okay. You go ahead and do your drop in. And then let's say another month goes by and you're somewhere in October now. And around this date here, you say, okay, it's continued to go up. I feel really good about this. I'm going to buy in. Now, if you go back here, you got a pretty good deal, way back here. You could have put your 30,000 in, right, at that time and bought it really low. But for a lot of people, they're just uncomfortable. That's the thing that you have to take into account is really kind of decide for yourself what's your comfort level, it's called your risk tolerance. Um, how comfortable are you really, with putting that much money into the market when you're unsure. So over time, you're going to gain confidence with this. And let's say, you've done this, the $30,000 was invested, and maybe a year from now or 2 years from now, the market's been going up. Let's say you get that bonus again, the $30,000 comes to you. Maybe this time you look for a great opportunity, like a buying opportunity. So you go and you look at the market and you start to look for, these swings in the market, and you get a little more comfortable. And then you say, okay, this time I'm putting the lump sum in. I'm okay with it this time. The market's, continually going up, right? So again, there's no guarantees. And I have to always give that disclaimer with investing. There's no guarantee that this is going to always go up. We're going to have years where it's not going to perform as well. This year happens to be a really great year in the markets. So, but I just wanted to give you that explanation to help you make your decisions when it comes to investing, to really kind of give you the whole lowdown to help you decide. All right. So thanks so much for watching the video, and I will see you in the next one.